Hello and welcome to the special segment called as MC Pro Select Stock of the Day. I'm your host, Nikki Mirchandani, and in this segment, like always, we bring to you fundamentally strong investment stock ideas. Today, we are going to be talking about KEC International. A bit about this company, let's get to know more about the background. Holds a prominent position in T&D with very long experience in the sector, enjoys high market share in the domestic market, solidifying its position as a leader. Now, the company has a solid execution and technical capabilities in handling critical projects. It also has built in strong capabilities in other emerging sectors like railways, solar, and civil engineering. Now, in terms of the recovery that is also seen in the business is something that is remarkable. During Q1 FY24, the company's revenue grew by 28% year-on-year basis. Solid execution and higher contribution from non-T&D segment essentially helped in delivering strong volume growth and revenue performance by the company. With the higher scale and control over cost, operating margins also improved for the company. EBITDA margins improved by a good 68 basis points to 5.8% on year-on-year basis. Balance sheet improved by 6% due to reduction in debt and 22 days reduction in the net working capital. During Q1 FY24, the company also backed in 4,500 crore of orders, which was up by 30% year-on-year. Now, does the stock still provide an attractive entry opportunity? A couple of reasons out there. First one, it has a strong order book of nearly 30,125 crore, supporting its strong earning outlook. Apart from that, the order pipeline, particularly in the domestic T&D space, is also improving and robust. The company expects higher contribution from its international business and subsidiaries driven by cost reduction. Also, with the resumption of T&D capex, higher planned investments are expected over the next 6 to 7 years. The current order book provides strong revenue visibility as it's executable over the next 3 years. Now, the company has guided for close to 12 to 15% revenue growth in the current financial year. It aims to achieve operating margins of about 8% compared to current 5 to 6% margins. Reasonable valuation to provide support too. Now, the stock is currently trading around at a multiple of 22 times its 1 year forward estimated earnings. The valuation at this point of time seems to be reasonable given the strong order book and the strong recovery in earnings that the company has clocked in Q1 FY24. Improving balance sheet, lower debt, working capital and operating margins are also expected to support the stock. In terms of things that need to be watched out for, a couple of reasons, a couple of factors out there. First one, keep a close eye out on the fresh orders as the company is expecting to get more orders. Contribution from subsidiaries and sustained improvement in the margins would be key to growth. Any slippages also could hamper in growth and put pressure on the earnings. Well, with this, it's a wrap. Thank you so much for tuning in.